Namaskara guys, this is Stock Yatra and we'll be looking at a new series of lectures on the basics of the Indian stock market. We'll be starting right away. So we'll be looking at demystifying the Indian stock market. We'll be exploring the basics, unveiling the mechanism, unraveling the different investment strategies and decoding the different jargons used in the stock market. So the objectives of our course will be to understand why we need to invest in the stock market, what is the stock market, how the stock market works, the safety and regulation aspect, the intermediaries and middlemen involved. We'll be looking at the different determinants of the share price. We'll be looking at the different corporate actions that each company takes. And we'll also have a glimpse at the primary market, which is also the IPO market. So with the objective set, now we'll start the first module, where we'll be discussing why we need to choose equity or the stock market. So equity and stock market are interchangeable terms. We'll be looking at why we need to do it. So as everybody knows, inflation is the most important part of managing our finance. What is inflation? Inflation, as shown here, it is that growing cost of living. The prices of basic amenities will keep increasing with the advancement in time. This is what we call inflation. For example, in our grandparents' times, a kg or a kilogram of rice would have been around 5 to 10 rupees, but now the same rice, which is a basic amenity for everybody, now costs around 50 to 60 rupees. So this growth or this rise in the cost of living is what we call inflation. And as per the consumer price index in August 2023, the inflation rate is at 6.83% per annum. So 6.83% increase in the cost of any basic amenity is a huge thing. So we'll have to beat this inflation to be able to afford what we need with the same amount of money that we have. To beat inflation, we need to have a source of income. Many of you might already have an active source of income, but we'll be looking at how we can make the stock market our secondary source of income. It can be either active income or passive wealth generation mode. So active income, we'll be looking at how to trade or how to put in energy and effort in the stock market and get returns. This is what we call active income. So passive wealth generation means that the wealth or the money, capital that you put in or invest in the stock market will grow at a passive in a passive mode. This is what we call passive wealth generation or passive growth. So the stock market can act as both an active source of income as well as a passive source of income. For active source of income, we need to put in a lot of effort. Not exactly a lot of effort, but we'll have to put in effort. But in the passive source of income, we wouldn't have to put in much effort or energy in the stock market, and the stock market is going to reward us sufficiently enough. Then we look at the other financial instruments that we traditionally used to trade. So the other traditional financial instruments, as we can see here, are certificates of deposits, bonds, stocks, cash or cash equivalents, derivatives, bank deposits, and loans and receivables. Most of these are fixed income sources, which means that the return on investment or the ROI is going to be fixed for a year. Most of them are from the range of 5 to 7% rate per annum. So this 5 to 7% in fixed income is not enough to beat this 6.83% inflation rate, because if you have a income growth of 5% per annum and an inflation of 6.83%, whatever we used to buy with a capital of 1 lakh this year, we will not be able to buy the same amount of things the next year. So we'll have to look at any source of income that can grow at a rate more than 6.83%. So for that, we'll be choosing different investment opportunities, and most of the traditional income instruments or the financial source of income do not yield satisfying returns. That is the reason we'll be looking at a rapidly growing instrument like a stock, and we'll be discussing the other advantages and risks associated with the stock market. So as we can see here, equity is an asset and not a liability. What this means is that many of you might be interested in buying vehicles. These vehicles are actually a liability. because they depreciate over time. The value depreciates over time. So depreciation is the term used to indicate a decrease in the value over time. So if you had bought a two-wheeler worth 2 lakh, say this year, 5 years ahead in 2028, we would be able to sell it only at a rate of, let us say, 80k. So this decrease in the value is what we call depreciation. Meanwhile, assets that are not liabilities, like the stock market or any shares, are appreciating assets. So their value keeps increasing over time. So they appreciate. Even real estate is an appreciating asset, and we'll be looking at appreciating assets for our investment and not at liabilities. With this, we look at the different risks and advantages of the stock market. So we'll look at the sweet part first, which includes the advantages. So we'll be having a high CAGR. So CAGR is the compounded annual growth rate. So we'll have a high CAGR. So we'll be looking at somewhere between 7 to 21% return on investment per annum. So the 7 to 21% is based on your knowledge. Your knowledge about the stock market is going to determine whether you're on this end or in this end of the return. To be on this return, you need to have quite a good amount of knowledge, which we will be providing at Stock Yatra. So don't forget to subscribe, like and share our videos, and stay tuned. To stay tuned, hit the bell icon. So the other advantages here would be a dynamic return on investment. As I said, anywhere between 7 to 21% per annum, your returns can keep fluctuating depending on the market scenario. If the market is rising rapidly, you are going to have greater returns. But if the market rises at a slower rate, then you're going to have a little lesser returns. But the average returns that you can expect is between 7 to 21%. As we discussed before, stocks are an asset class, so they do have an appreciation in their value. And like most of the others say, the stock market or equity market is the fourth best source of income. The first one would be your job, or the job that you pursue is the first best source of income. The second would be to start a business. Opening a business is the best source of income to grow your money rapidly. The third would be real estate. And coming to fourth, we'll be looking at the equity market. And we also have an additional source of income. Apart from appreciation, we also have an additional source of income in the stock market, which are dividends. We'll be looking at them when we discuss corporate actions. Now, coming to the risks. Discussing just the advantages is not what we intend to do. We intend to provide you a holistic view of the stock market so that you can assess better and you can assess your risks and manage them quite well. So the risks or the disadvantages of the stock market is that, as I said, anywhere between 7 to 21%, the higher return depends on knowledge. Likewise, lack of knowledge can result in heavy losses. So, as they say in the advertisements, market investments are subject to market risks and high volatility. Volatility is the term used to determine a huge fluctuation in the price of a share. When there is a high volatility and you investment at this top price, the prices are going to fall rapidly to the bottom. This high volatility can result in huge losses. Likewise, if you had invested at the right time, that is the bottom, and you had taken out your capital at the top, you would have made huge profits too. So likewise, it's a double-edged sword. You can have both good and bad in the stock market. That depends on the knowledge that you have. And like we saw in the COVID-19 crisis, the market had fallen hugely. So global and national crisis times, even the Russia-Ukraine war, even in such cases, the market is going to fall. And whatever is your investment just prior to the arrival of the crisis, your investments are going to go down with losses. So this is also one more aspect to keep in mind. Now, most of you would be quite paranoid with investing in the stock market. This is because many of you would have heard that the safety in the market is very low and risks are high. You would have heard personal stories or first-hand experiences shared by people where they share about frauds. They would have invested a couple of lakhs with someone in their friend or friend of friends, and they would have swindled their money. So these cases are actually present in the market but quite rare. The reason is we have a body or an intermediary called SEBI, which looks after the rules and regulations of the market, and they are very strict nowadays, which means that the ability to fraud someone is quite low. So the risk of losing money to frauds is very, very minimal, while the risk of making losses do exist. So frauds do not exist nowadays, but the risk of making losses on your own is the only risk that we have to target. If we can manage this, the only thing that we look at will be the profits. With this said, we've discussed why we need to invest in the stock market, or what are the advantages of investing in the stock market. And just keep in mind, when registered intermediaries, SEBI actually mandates registration of financial advisors. So these registered advisors are safe to play with, while the non-registered entities, you need to stay away from them. With this said, we'll look at the next module in the next video. Stay tuned, hit the subscribe button and hit the bell icon. Watch out for our next video on what is the stock market. Thank you. Jai Hind.